Let's turn back to today's jobs number. Payrolls rising 22,000 in August. That's less than expected and a further sign of a hiring slowdown. Joining us this morning with first reaction from the White House, National Economic Council Director Kevin Hassett. Kevin, welcome back. Happy Friday.
Yeah, great to be here, guys.
Jim and I were just talking about when the numbers out of BLS will start to reflect the tone of investment that we got at the dinner last night. Is it just too early?
No, well, first of all, I think what you have to do is remember that, and when you're looking at an economy, you have to look at like the whole portfolio of numbers that we have to look at. This jobs number was certainly a little bit of a disappointment right now, but one of the things, there was a Goldman Sachs study that came out yesterday that showed that because the BLS hasn't really done a good job on its seasonal adjustment in August, that they tend to revise this number up by almost 70,000 jobs when they give you the revised number a month later. And so you have to sit back and think, well, what's really going on in the economy depends on lots of indicators, and here are the ones that we're looking at that are giving us the judgment that the economy is sound and inflation is low. First of all, we're having a capital spending boom. Capital investment is up 8% over the first half of the year, which is really, record growth in capital spending. We've got industrial production at the highest level it's ever been. And so we're really cruising into, I think, the kind of capital spending boom we had last time, the last time that we had the big corporate reform. And so against that backdrop, that's exactly what you want to see in terms of you got supply side driven growth, so therefore you're not putting inflationary pressure on as well. And finally, with respect to the great dinner last night, we're already seeing productivity going way up because firms are using artificial intelligence to improve what they do. And right now it could be, our productivity is kind of hard to guesstimate, but it's looking like it could be going at about a 3% rate this year. If you figure that you're going to get 1.5% growth, potential GDP growth out of labor and capital, that means that you're looking at an underlying trend of almost 4% growth, or even bigger than 4% growth because of this AI. So we're very excited about where things are going. It's a little bit of a disappointing job number, but I pretty much expect it's going to revise up.
All right, Kevin, Jim, it's so glad you're on because I kind of want you to settle a bet I had with some people at the game last night. I've got people who are telling me, look, that there are that we're in an economy where everyone, when you come out of college, come out of business school, come out of law school, there are no jobs for you. And then I got others who tell me, hey, listen, it's never been this good and everybody's got a job. Can we just tell me, are people getting hired when they go to graduate school? Are people getting hired if they graduate college? Or is it longer than when you and I went to school?
Right. Well, the hire rates are about what you would normally see. Members of my family have been hired. Both of them started their new jobs about a week ago. And so you are seeing that people are being hired. Perhaps in some areas it's slower than people thought. So, for example, we know that people who invested heavily in computer programming skills, their jobs are being squeezed a little bit by AI being able to code. But for the most part, we're seeing labor force participation go up and the unemployment rate stay about steady.
All right, so also, just in terms of what people are spending on, we had a company, Lululemon, I don't want to get too granular with you, but you're a person who knows a lot about business, that reported really bad numbers. And I'm starting to think, you know what, the American people have gotten pretty smart. They're not spending $78 on T-shirts anymore. And then I start thinking, are they getting smart or are they getting strapped? I can't tell, but there does seem to be a wisdom among the consumer that just says, if you're charging a lot, we don't like you anymore. Democrat, Republican, we want reasonable prices. Do you see that?
Yeah, well, I think the one thing we know is that people have more money in their pockets. And so, again, in this jobs report, there were very good news, right? That all of the job creation was private sector. Government jobs are down about 100,000 since President Trump took office, and it was all native-born workers that were getting the jobs. And on average, so far this year, the typical worker is making $500 more than he was in January. So that $500 could be spent, on a $70 T-shirt, or perhaps they're doing better things with their money than that. But they do have more money in their pockets, Jim.
Kevin, there was a nice report yesterday out of BNP Paribas. The title was Bye Bye Buffer. And the argument was that we're entering a new phase of the tariff story where companies increasingly can no longer rely on their pre-tariff inventory levels. They think that buffer largely depleted by August or September. You think the economy's prepared for that?
I think the economy is definitely prepared for the tariffs. So the way you're seeing it is we're having this capital spending boom. I was meeting with the CEO, I won't say which one, yesterday because I don't want to get ahead of his earnings announcement, but he talked about the billions and billions of dollars that they were spending here in the U.S. so that they can get the production to be built here. And that's the other reason why you're looking at the investment number that I said, up 8% over the first half of the year. That's because everybody's rushing to make stuff here. That's going to drive incomes higher here. And I guess the only thing that it might do is make tariff revenue be less than it has been in the last few months because everything's being onshored.
Now, I do want to go back on the executives who were at the White House yesterday. The construction job number is literally been pretty much unchanged. I don't understand this. I've been in data centers. Kevin, to build these things, it's just monumental, whether it be the cement, the aggregate, all the different racks, all the different people moving things around, the warehouses that are connected to it. Who's doing that? Because you need construction people to do it, and we're not seeing that pick up. I'm not, again, not being political. I'm trying to figure out, are we building things better than we used to?
Well, the capital spending that we've seen really skyrocket, right, is for factories and machines and so on. But the housing sector is still a disappointment. It's something we're studying closely at the White House. And the housing sector probably employs as many construction workers as the other side as well. So I would guess that's what explains the puzzle.
Well, that could change soon when we see these mortgage rates. And that would be great. 10% of the economy is housing, and it's been hurting us, and I hope that comes back.
Yeah, Kevin, we were just talking, Jim and me, about whether or not this cycle of rate cuts, assuming we go into one, will be different than the one last fall when mortgage rates actually climbed into the rate cutting cycle.
Well, I think that in the end, right, if you think about it, the long-term interest rate is the sequence of shorter-term rates. And so if you think that inflation is going to stay low and so short-term rates can stay low, then you should be bullish about what's going to happen to long-term rates. And we are actually seeing it with the 10-year and the 30-year that people expect that the supply-side growth is something that won't be inflationary, and that'll take a lot of pressure off of the Fed. And so, yeah, I think that there's a lot of reason for optimism right now. I think after the jobs report today, you've seen federal fund futures move quite a bit so that they're now expecting a third rate cut this year, almost. And so I think that that's the kind of thing that moves longer-term markets, because if you think the short-term rate's going to be low for a long time, well, then that affects the long-term rate.
Right. Average hourly earnings year on year 3.7. You know, the Fed chair did talk at Jackson Hole about whether or not a boost in short-term inflation due to tariffs could migrate to wages and what workers are asking for. I guess would this kind of number suggest that workers do have that kind of leverage?
Right. Well, what we're looking at is we like to look at the real wage increase. So the real wage increase right now is about 1.6%. That's about triple the average over the Biden administration. And so once again, we're showing that if we make America friendly for business, that it's good for America's workers. And again, if you've got higher real wages, then sure, whatever happens with inflation, that means you got more money in your pocket than the extra money you have to pay for goods.
Kevin, just want to talk about this Fed independence issue. I think that I've always felt that it's vital because you grew up thinking that. And I do believe that what's happening, some people feel, is a chilling effect, obviously. Where do you come out on the idea of being sure that the Fed is, in the end, independent no matter what? Because I know that countries that have independent Feds tend to have better long-term growth rates than countries that don't.
Yeah, that's absolutely right. There's no question that an independent Fed is really important for long-run growth. That's been shown over and over in the academic literature, and it makes just good common sense. I think at the end, what has to happen, you can assert you're going to be independent, you can assert you're going to be nonpartisan, but in the end, the proof is in the pudding. You have to look at the things that the Fed's doing and decide for yourself whether it looks like they're doing that just because of what's happening in the numbers, or are they doing it for some political reason. And so if you look at the facts of like the big rate cut right before the election, which presumably could have helped Harris, if you look at the fact that there really wasn't much squealing from the Fed when all the Biden spending was running out of control, they didn't start hiking rates until Jay Powell was renominated. Like those all could be like completely innocent things, but when you see partisan patterns like that, it should make people wonder, is this Fed really being independent? And I think that it's really important for a Fed to kind of keep a scorecard that proves that they are being independent. I can remember I went back and looked, and And it was almost never the case in the whole history of the Fed that Feds moved interest rates in any direction right around a presidential election. And you can see that, well, that's a Fed that's making sure that there aren't political patterns in their actions. And that's what I think a future Fed should be doing.
Finally, speaking of the Fed, I imagine the White House has seen this report out of ProPublica, looking at mortgage paperwork and finding that at least 3 of cabinet members call multiple homes their primary residence. Of course, this has implications for the argument surrounding Fed Governor Cook. Any response?
That's a matter for those cabinet secretaries who I don't understand their family situations. I've only ever had one home, and I don't have a mortgage on it anymore. So yeah, that's all I can say.
Kevin, appreciate the time this morning.
Thanks,
good to
guys.
talk to you as always.